about we change the name to Options Unraveled?
Market unraveling right
Yeah.
now.
Real quick, just obviously this will be the basis for our chat today, folks. But having a bad day in the market, we're showing some green in the pre-market, and Oracle turned the market with Blue Owl pulling the plug on the Dana Setter. That's building the Oracle, making a new low of the move, $3 off its current low, but we've seen that trick again. Bringing down Broadcom along with it, and Nvidia. Here we're at trading on the lows of the session. And boy, oh boy, I hate to look at this daily chart and tell you folks that I don't see any support for another 60 handles. Good afternoon, CC. How you doing
How you
today?
doing? That was a terrible welcome. Like, it's dire. No. Well, I was just joking with Joel before we came on. The date, like a lot of times, once a week I'm appearing. Sometimes the mood is set by what the market's doing that day before we start the show. But I have to agree here. This is a little scary. And the fact that we're only a couple percentage points off the highs, I think, is a good opportunity for, maybe as an investor, at least challenge some of your assumptions into year end, challenge some of your assumptions into 2026, and see how exposed, how levered you are up here. Because again, you guys were on pre-market prep this morning as the Oracle news hit. And if you think about yesterday, so we've had a couple of weeks where tech has been underperforming, right? Tech's been under pressure. I mean, it goes back further than that. But what was particularly interesting the last 2 weeks, I would say, is that tech was under pressure. But every day it was like, some other sectors where they're, enough, we're carrying the load enough to kind of hold up the market, right? And it was financials, it was consumer staples, it was industrials, things like that. Yesterday was interesting because some of these stocks like Oracle and Broadcom and all, and Nvidia to a lesser extent, but Nvidia too, they had a great day yesterday when most of the market was down. So it sort of felt yesterday, I would say, like, oh, that's an interesting setup. Maybe tech, maybe that was it, and tech starts to bounce and Oracle starts to bounce and, kind of takes us higher into year end. And then you get that news this morning in Oracle. And I don't know, like what your thoughts are on this, Joel, but like why that news hurts so much today is it kind of confirmed all the skepticism in this AI story, right? So back when Oracle first made that gap higher, that meme stock like gap higher, it was all based on this these massive numbers. Like, I think we just stopped paying attention to how large the numbers were at some point. It was like, we're going to spend $500 billion on this data. We're going to find, that whole AI build out thing. And they were all, numbers kind of pulled out of people's asses at the time. And I want to say even Elon Musk said it that day when that first announcement happened. It's like, no, they don't have the money for this, like what they're talking about, that big press conference at the White House. So anyway, so fast forward to today, after all of this weakness and all of the, the reversal in Oracle and the weakness recently in Broadcom and the weakness in Nvidia, you get to this morning and it's kind of confirmed what everybody was worried about, which is a lot of this stuff might not happen. And so therefore, the reason you saw Nvidia go down this morning was, it's the entire bull case in Nvidia. Everybody's like, Nvidia is not an expensive stock. Well, a lot of that is dependent on this spend being even close to these numbers we've heard over the last, 4 to 6 months. And if this story is being put at risk that these numbers were fake, which was always the bear case the last 6 months in these stocks, oh man, like, you could see with the concentration in the queues of these stocks, if you saw these have like a decent pullback, Nvidia to 150, these kinds of levels, man, that's like, that's a pretty significant chunk out of the market.
Yeah, and I think also, kind of, playing into it is, a lot of people, many, positioning himself for the Santa Claus rally.
Yeah.
Seasonality, right?
Yep.
And that, Dennis has been preaching it pretty hard. Really didn't work out last year.
Yep.
Really, with it. Will it be 2 years in a row? Um, technically, we were up near the highs, and actually the name of the show I had the other day is I called it Chicken Little.
Mm-hmm.
The sky is falling, the sky is falling. And
Right.
the reason I said that is because a lot of stocks were getting crushed. The S&P is relatively close to, all-time highs, but now, I mean, you still do have, some stocks in the green. Microsoft, well, last I looked, Goldman Sachs was having a good day. So,
Mm-hmm.
is it, how is it the other 493 of the Mag 7? How long can they hold this market? We got a question coming in from the chat here. How much is this the Japanese unwind? I mean, that was a factor before, rates going up in Japan, the carry trade. I mean, that's a factor. It hasn't really spread like it did. What was that? April, or was that
The yen carry trade in
yeah.
April or whenever that was. So the Japanese story is interesting because we're going to find out in the next 2 days, and there's obviously what the Bank of Japan is going to do late Thursday night, early Friday morning, but we also have the CPI tomorrow morning.
Oh yeah.
And so what I would say is somewhat interesting is it was hard to tell what the US Treasury market was implying into that rate cut last week, or because yields were creeping higher. So you had that like the 10-year, for instance, went basically from 4 all the way up above 420, right? Or around 420 into that rate announcement or rate cut. And then it kind of pulled back a little bit. Now, was that the US Treasury market, was that it getting ahead of the fact that it might be what were they talking about, a hawkish rate cut, right? Or was it the Japan stuff? And it might have been a little bit a combination of the two. And the Fed essentially admitted a problem during that, when they made that rate cut, the Fed admitted some weakness in being able to control basically short duration treasuries, and that they're going to get involved in the buy-in program, they're getting involved in the repo market, blah, blah, blah. But it was kind of interesting because if Japan's going one way while the rest of the world is trying to still go, the other way, if Japan ends up winning, it is, it's a problem. And all you got to do is look really far out on the curve right now. The 10-year, the 20-year, the 30-year, especially, those yields are all creeping higher when we're in a year and a half long rate cutting cycle right now. So there is something to that question. I think we'll know more over the next couple of days, what Japan says, and also how yields react tomorrow morning to the CPI. We got the jobs number. They reacted pretty well, I would say, to the jobs.
But they did, but it was sold.
Yeah.
It was sold.
So
I mean,
if they follow through on, the CPI comes in and it's kind of cool on the cool side, and, treasury yields go lower, it might not be Japan then.
If it comes in hot, then
it's history. Yeah. We're cooked.
Okay, let's look at expected moves. We all know they play a factor in the markets for expectations. Of course, once you exceed the expected move, crazy things can happen. But let's just run these down and where we at.
So last week, going back to last Wednesday, we were doing this right before the Fed rate announcement, rate decision. And this is about, then maybe even slightly lower, I would say lower volatility expectations. Now, this, of course, includes the first couple of days of next week. This takes you basically right into Christmas Eve. And we've pumped a little bit over the last couple of days as we've seen this volatility this week. And obviously, the lower we go, the volatility continues to increase. But there's an interesting point I want to make about this. So you can have a look at these 1 week ranges, right? So they're getting pretty wide. The SPX could take you back up to 6,900 theoretically over the next week if we got a bounce here. From an options market perspective, we had been so long, and Joel, do you want to go to my SPX chart real quick? And I'll try to show what's going on here a little bit. So
remove this one. Sure.
Yeah. So basically, just to set this up, so you have, everybody kind of knows everybody watches the VIX. And when the market goes lower, the VIX tends to go up. And when the market creeps higher, the VIX tends to compress, escalator up, elevator down, right? There's another component to that, which is that there's already skew in the market, right? So you actually, when you go lower in the SPX and you start going down and you're hitting, another 50 points lower and then another 50 points lower and then another 50 points lower, you don't even need panic in the market. Those puts were already at a higher volatility. And as you go lower, those puts, the VIX is going up simply because of that, the curve, the skew of the option volatility. Then on top of that, people start to get worried and people start to bid up puts, right? So the condition we've been in for, going back to essentially October is we're basically flat, right? The SPX is flat in October. Qs are down. We've spoken about some of those stocks like NVIDIA that are essentially flat from the summer or maybe even slightly down now. But anyway, this range, as long as this range has continued to hold, we've been sort of stuck right south of 7,000 in the SPX in a very heavy gamma loaded area of the market based upon everyone having sold a lot of calls up here into year end, right? Now, a lot of those are going to expire over the next couple of weeks, and we'll get to that. And actually, a lot of them are going to expire on Friday. But what's interesting here is if we were to, get a hot CPI, if Japan spooked the market somehow on Friday, that's above my pay grade on exactly how they would do that. But you would basically get into year end, especially after this Friday and a lot of these options expire, where you still have that overhead resistance into year end from a lot of options having been sold, but you basically have none of the support left into year end. And not to scare anyone, but that it's very similar to what I've been saying the last couple of shows, which is we have, I still, and who knows how this day ends and how this week ends, but it's to me, it's been a higher percentage that we get that Santa Claus, or higher percentage probability that we get that Santa Claus rally into year end and edge up close to 7,000 in the SPX. But that, during this whole time, that's only been a couple of percentage points. And I never thought we would get through that area before year end. I thought there's going to be massive resistance. And I've been saying this for months. And you can see we've knocked in this area. We've gotten up to just above 6,900 in the cash, whatever that would be, 50 points higher in the futures. And we've gotten up to that area and we've just gotten slammed multiple times now over the last couple of months. This is a 3-month chart. So we still could make another run at it. The news could turn out well and, everybody gets back into year end, but we're not getting really much over this level into year end. There's just too much resistance in the options market, in year end price targets, all of that. And what I've been saying the last couple of shows is, although I thought it was a higher probability we do get that Santa Claus rally, that's only about 2.5% to the upside, as opposed to us failing again and this turning out to be a double top. And that means a much bigger potential move to the downside. So when we look at let's go to that other card with the year end price targets or expected moves. So this is what's fascinating to me is you look about right now, and I did this, an hour or two ago, so they might not be exact, but if you look at the SPX, the expected move is basically back to the prior, the recent highs, which was only a couple of days ago, really, or as close as we got a couple of days ago. The Qs don't even get you back to the highs into year end. So the options market's almost thrown in the towel on the ability for the Qs to even rally back towards their highs by year end. IWM is still hanging out near its highs and everything like that. But what I would say about these expected moves is they are still not completely equal. So if we were to get a bounce in the SPX, I think that expected move is perfectly reasonable. If we were to see today's action carry over into the next couple of days and carry over into, that kind of holiday trading, that expected move to the downside is probably still too cheap, even after the last couple of days' move. And so I still think we're a little bit skewed to the downside as to what could happen into year end. But I don't know. I'm about 50-50 which direction we go here into year end now. That was a lot.
Yeah. I think what the problem is, though, is with the kind of for a rally, for a serious rally to matriculate, is that you built up a lot of overhead supply.
Yes.
And so and I'm just going to go back to the jobs data on Tuesday, right? They found sellers.
Yeah.
And so, and now what happens, if you had sellers, hey, we're going to sell on strength up near all-time highs. Well, we lost all-time highs. Well, now we're going to come down to here. And so now the lower that we go here, the lower those offers are going to be coming down. So
yeah,
I don't want to be, what do they call it? The Grinch that stole the Christmas rally here.
Yeah.
But I mean, it depends of how low of a level that we get to, right? But for me, when I look at markets, when is it easier to identify support or resistance? Right now, I mean, I'm a daily level guy. I don't see support for another 50, good support for another 50 handles.
Yeah. And you've also got to take just sort of the price action into account here, where it's almost similar to, I don't know if you keep an eye on Bitcoin.
Yeah, of course. I keep an eye on the futures. Yep.
Bitcoins, let me just pull up like IBIT and you can go to my chart.
Okay.
So this action today, I mean, look at this, right? So that has happened multiple times over the last, this is going back to, almost a month. This is a month ago, basically. Look how many times these kinds of bounces in Bitcoin have failed, right? Now, not that Bitcoin is in any way a perfect representation of, let's go to the Qs. Not that it's in any way, but it kind of gives you a sense of, it can give you a sense of some investor sentiment. And there's only so many times that you can, you can get a head fake higher before you just kind of throw in the towel. So now we're looking at the same thing in the Qs, and look at how like gappy this is starting to get up here and this rollover. So what I would say in all of this, and the SPX and the Qs included, let's look at a level here. I mean, the Qs at 600, it'd be nice if they held here, right? A big round number. If they don't, I mean, what are we talking about? We're talking probably 590, I would say they need to hold. But if we go down, another couple of days from here, it would have to hold 590 because otherwise this looks like a terrible rolling over top. And that's sort of like that kind of price action. It's got me a little worried, I would say. Now, we could, CPI comes in cool. We could end this week with like a little bit of a bounce, and maybe that changes things. And then everybody starts to think about the Santa Claus rally again. But this has got me a little worried into year end. And then it's got me a little worried as to like how we're going to start January off, I have to be honest.
Also, I mean, whether you're looking, and I brought this up in the S&Ps today, I mean, you were struggling with the 50-day, and it actually being quite near, the high of the day today is the 50-day. I mean, well, actually, it's right around 68.50, which is right around the close. We have not been below the 50-day moving average since July.
Yeah.
And we have not been below the 200-day moving average since May. So on a lot of cases, and I'm not saying S&Ps are going down to 63, 80, at least at this time. But how many times do you see? I mean, a stock that once it loses their stock or future, whatever it is for being used, once it loses the 50-day, and that 50-day becomes major resistance. I mean,
Yeah.
you could look at your daily levels, but how many times do you come down and test the 200-day? And there's a lot of other things going on geopolitically.
Yeah.
Things are not exactly going according to, in Washington. There's a lot of, infighting within the Republicans themselves. I mean, Bitcoin, leading indicator of a lot of things that, and just going to that I bet chart there, when
Hmm.
you come down and you make low on something and you bounce off it, and then you come back down to that low again, the probability of that low holding really, really diminishes it. And we looked at that trade. I bet we had set it up earlier when it made that low. So you have a level to lean on. But the more times it comes down and hits that level, more of a chance it's going through.
You usually only get two shots at this, right? And you could argue that, here's that prior to Thanksgiving week low, and then it failed. You got a second chance here. It stopped a little short of that. I mean, I would have to say that this, you would think, here you could draw like a little bit of a trend line, I suppose. You would have to hold this level at 48, 50, which, is probably Bitcoin. That would be, I don't know, 85, 84. Where
Yeah.
are we at now? So that's a great sort of like trading sentiment indication. And I've got a personal opinion on Bitcoin. I'm actually positioned long into year end in Bitcoin. We talked about that last show, but I will say that, you start looking at those micro strategies, or what do they call themselves now, strategy. Start looking at their cost basis, because unless I have something wrong, they have a problem that is so dependent on Bitcoin continuing to go higher, which is the higher Bitcoin goes, the bigger they grow, the more money they have to deploy into Bitcoin. So they're unlike, and you could say, well, every ETF is like that, like the SPY and the Qs and everything. They have to pile more money in the higher it goes. But those companies grow in earnings, right? Like the S&P grows in earnings over time. There's nothing other than the stock, or other than the price of Bitcoin continuing to go higher, to support that. So all of a sudden, what I would say is the markets like to test cost basis, right? They like to figure out where most of the money owns that stock, right? And then they try to test it, and they see how strong those hands are, right? So, we're talking about strategy, and we could go to like a Mr. chart. I think I want to say their cost basis is 70 something in Bitcoin, 74,000 or something in Bitcoin. And man, well, hey, look at this chart. That's a 1-year chart. But you would have to think that if Bitcoin were to break down from here, that it's probably going to test these companies, and it's going to test right around where their cost basis is. And I don't know if they've ever sold, if Michael Saylor's ever sold, but we're going to see what he's made of if that happens. That's for sure. And that's interesting.
Yeah, definitely weighing on the market here. The last I saw, in December of 25, it was around 75,000.
Mm-hmm. Yep.
After adding 10,000 Bitcoin for about a billion, of an average price of 92.
Okay.
So
Yeah.
the total
Yeah.
stash exceeding 671,000 Bitcoin, funded by most equity in debt. So there's your uncle
You said
point.
the magic word there, debt. So let's, now that we've got it all bearish, and by the way, I have no idea how we're going to finish into year end. I can just sort of, I would, if you made me flip a coin right now, I think we probably bounce a little bit into your end. But sort of overall, I'm starting to get a little bit more worried with the action, and Nvidia not being able to hold a bounce, Bitcoin not being able to hold a bounce, Oracle not being able to hold a bounce, and all of that. So therefore, let's talk about the options market and what one would do there, right?
Okay.
And so I would never say get all bearish and sell all your stocks, obviously.
I would.
So let's talk about a couple of things we've talked about over the last couple of weeks. So last week I mentioned IWM. And so at the time I was looking at the yields creeping higher into the FOMC announcement, and having watched IWM basically be the only major index into that Fed meeting that had actually broken out to the upside over prior highs, right? S&P was short. Qs were much shorter than their highs into that meeting. And I'm looking at IWM, and I know it has regional banks. It has, there was a weird mix that maybe was taking it higher. But I was sort of looking at it and saying, man, if the FOMC disappoints in some way, or the reaction to it is, yields going higher or continuing to go higher because they were creeping into the meeting, I was really skeptical of IWM. And then, of course, over the next couple of days, I was proven absolutely wrong. So IWM kept going higher after that meeting. And then something that interesting has happened in the last couple of days where it's come back in. So this was the hedge in IWM that we discussed. It's now working quite well. I don't know where I would kind of ride this to, but it's probably a lot lower than here, maybe to see what happens at 240 in IWM. But that was an interesting hedge, and the expiration we picked was January 16th. So this is still a month away. And this was, what if the market rolled over? What if the reaction to the FOMC wasn't that great? And it's starting to work. I looked wrong for the first couple of days after, but now it's starting to work. All right. So now that's last week, and that's what we discussed last week. So now let's go and look at the Qs. Let's go, and I've got another kind of cheeky idea, and this depends on your level of how scared you are, how sort of levered you are to the Mag 7, which everyone is. If you own anything, any ETF or index, you are massively levered to these stocks. So today I was looking at, and today might not be the best day to think about hedges because the market's weak and you kind of want to do this sort of stuff on strength.
Yes.
But I was looking out to did I do the December? Oh, enter December 17th. All right. So this is February in the Qs. And I was looking at this chart and I was saying, and again, I'm not sure if I would rush into a trade like this. I would actually look for, ideally a bounce up to 610, let's say, or 612. And that I think would be a really nice entry point on a hedge like this or a trade like this. So this is looking out at a longer term Qs chart but only out to February, and saying, all right, what if we start January off? What if we finish badly into New Year's? And what if January starts off and it sucks, right? So I was looking at the 600 550 put spread in the Qs. And what that does is that gives you a break even, it's at 590, right? Which is only a 12 points lower than here. And it's down 10 today. So it's not unreasonable that if we rolled over that you would go right through that break even very quickly. And it protects you if it's a hedge or if it's an outright. It takes you down to the 550 level, which isn't an exact of anything except for this kind of August low down here. But it's a big round number, and it costs about $10 when I was looking at it earlier today. And it's costing you $10, which the Qs have moved today. So just to put it into perspective, but it's protecting you for 40 points below your break even of 590. So if you're a little worried here, and maybe you don't do 50 wide, maybe you only do 25 wide or something like that to reduce the overall cost. But to me, this is, potentially spending about what the move is today to protect yourself. And now if you got a bounce and January started off, correctly, you could take this off before it goes max loss. So yes, you're risking $10 here, but it might be the type of thing where you're like, okay, I was completely wrong and we bounced and now everything's good again. And you take it off for like a $5 loss. You take it off for half of what you paid. And then you're happy because the Qs are higher and your whole portfolio is higher. So that's one. So we have the IWM we talked about last week. This would be what I would be looking at in the Qs. I'm kind of curious how we end the year and then how we start January. This is a trade like this or similar I would be looking to do on strength if you got a little bit of a bounce, into Friday, let's say. So the other cheekier one I just kind of wanted to bring up, and this is more of a long-term, I think it's over. I think the AI rally is over. I think the, S&P PE at 30 or whatever it is overvalued. And I think we might have a really bad 2026 that resembles, to some extent, maybe resembles what we were doing back in, 2023 or 4 or whatever that prolonged bear market was that was like 25%. So this is a Robinhood chart. And I'm not picking on Robinhood as a company. They make great products and everything like that. But man, are they ground zero for speculative behavior. And what I would say is if Bitcoin and the market and the Qs and NVIDIA and meme stocks, if it were all to go kind of kaput over the next 6 to 9 months or something in 2026 was ugly, this is an interesting one to do kind of just like an outright cheeky longer term trade where, you could maybe be looking out. I think the one I was looking at earlier today was this one's April. So it's not, but it's basically a 175 put spread. So this is basically saying if the market rolled over and Robinhood went with it, which it would, you would think, and it broke those recent lows, you're positioned for a basically 4-to-1 payout of risking 5 to make up to 20 on a $25 put spread. Now you could go farther out and you could say, all right, if 2026 is really ugly, man, like Robinhood, a stock like Robinhood could go back to 65 or something like that. And you could look out to, I don't know, if I wouldn't go out to year end or something, but you could look out to June or May and potentially do bearish positioning very similar, that these kinds of stocks could get really hammered in a prolonged correction. And I would think that if this were to happen and the market were to roll over, it does feel like it would be one of those multi-month prolonged types of pullbacks. And it would be the type of thing where every day you come in and you see NVIDIA down another 1% or something, and that just kind of consistently is happening, and Bitcoin can't hold here and it goes lower. I think, looking at stocks like Robinhood that are so dependent on this kind of investor behavior, I think is an interesting, cheeky, outright trade, maybe, if that's your view.
Okay. All right. We'll put a wrap on it today then. We got a lot to look at here, CC.
We were too bearish. Too bearish. I just want to say we were too bearish, but we're talking to what the market's doing today.
Okay.
So,
okay.
Yeah. Yep.
All right. Well, that's it for this, and we're going to certainly have a exciting expiration with you. So back with you all on Friday, and I'll be back with you at 3:30 with that closing print. And that should be a wild one. Thanks for joining us.
Awesome. See y'all. Good.
Yep, that's a good one. Thanks, CC.
Awesome. All right, Joel. I'll see you on Friday.